So my name is Ken Harris. I'm with First American Exchange Company. As I was saying, I've been with First American for almost 22 years. In August, it'll be 22 years. So I have the escrow background, and then I've been doing 1031 exchanges since 1999. And starting in 1031 exchange, I was running a desk too. So like an escrow officer would run their desk, I was running a desk as an exchange officer, where we did forward exchanges, improvement exchanges, and reverse exchanges that we were talking about. And I'll go into each type of transaction that we can do as far as 1031 exchange goes. So I have the background behind the desk, the knowledge of, the ins and outs and rolling your sleeves up and getting the deals done there. And then in 2008, when everything crashed, basically, we did more of a centralizing of the processing, which we do in Irvine, as we were talking about. And I got out in the field doing more educational stuff and sales rep type of stuff and letting people know, hey, we're still around, we're still financially strong, even in the down times, and doing 1031 exchanges. So 1031 exchange, are you guys familiar with it?
We have no presentation done by First American with more detailed office.
Okay, good.
On the basics of the 1031 exchange stuff.
Okay, good. Okay. So 1031 exchange is a tax code. And what the tax code says is property held for productive use in trade or business or as an investment property can be traded for like-kind property without the recognition of gain or loss. So what does that mean for us? Basically what's happening is you're taking a piece of real estate that has gain, typically 99% of the time, and you want to sell it. If you sell it and do not do a 1031 exchange, then you're going to have to pay a capital gain tax. And right now your capital gain taxes could be anywhere from 25 up to 30, in excess of 35%. So instead of paying the tax consequence, I literally get clients that call me and say, I've depreciated it to nothing, I'm selling it for $2.3 million, they're going to have a $600,000 tax consequence if they don't do the exchange. So the whole idea of the exchange is to retain that $600,000 and apply it towards other property or properties to hopefully net you more income. Nobody wants to pay that much in taxes. So it's a tax shelter they give us to avoid paying the capital gains tax. So in the tax code, in the definition I read off, there's a couple things I want to point out. Like kind and held for. So your flipper that is flipping properties, they buy property 3 months down the road, they fixed it up a little bit, they're going to sell it for a $50,000 profit, they cannot exchange. It specifically says in the tax code, property purchased with the intent to sell basically cannot exchange. So you have to have the intent to hold it as an investment property. Now, to hold it, it doesn't give us how long of a time frame you have to hold it for, but 2 years is usually a safe time frame. So if you hold it for 2 years as an investment, and then you want to exchange it again, then you can exchange it again and be fine. What I guess the IRS does is when you file for the 1031 exchange, they go back 2 years on your tax returns. Make sure who owned it, how long you owned it, you had claimed it as an investment property, you're collecting a rental income, or running your business out of it. And then also on the property you're ultimately going to purchase, or properties you're going to purchase, you're going to want to also hold that property for a couple of years typically to play it safe. Some attorneys or CPAs might tell you 1 year is sufficient. 2 years might be a conservative approach, but you get 2 tax filings under that property, then you've claimed your intent to hold it typically. Okay, so there's no clear cut. You must hold it for 2 years unless you go into converting to your primary residence, and I could get into that. Like-kind property too. So like-kind property, everyone calls me and says, hey, I'm selling a single-family residence rental. I have to buy a single-family residence rental because that has to match the like-kind property. Not true. So your like-kind property, as long as you buy you're selling a piece of real estate you held for investment or ran your business out of, and you buy a piece of real estate that you're going to also hold for investment or run your business out of, then you qualify for the like-kind. So you could sell a property here in California, residential rental, and then you could turn around and buy an apartment complex. You could sell an apartment complex and go commercial, industrial to residential. So it's all interchangeable as long as the real estate being exchanged for other real estate, both investment. Okay, and here's a great opportunity for you guys: is you have clients that are selling and then buying other property within 6 months. So typically it's at least 2 deals. I've had clients sell 1 property and buy 10 replacement properties, and the same real estate agent handled all of those deals that have to close within 180 days. So it's a great client to have for you guys and keep in touch with, because not only are they exchanging that property, there's multiple properties that they may own that they can exchange and keep exchanging. Every couple of years, a lot of them come back to us to try to, you know, diversify their portfolio and buy other properties or get into something bigger that can make them more money. So they're great clients to have for you guys.
One thing I need to ask you, I thought the maximum was 3 units.
For a 1031 exchange?
Right.
No. You could sell a 500 unit apartment complex and do a 1031
I mean,
exchange.
you do 1 unit, but you can only buy no more than 3 replacements, right?
No, you could buy more than 3.
Oh.
You could buy more than 3, but there's a rule to that. There's a rule to the identification. So we could get into the identification rules now. So there's a brochure. I know the people that are watching can't get into
For
the brochure.
For people who attend on the webinar sessions, I'm going to scan the brochure. I'll email it to everybody though.
And you guys feel free to go into my website too. A lot of this information is in my website, which is www.firstexchange.com, spelled out FIRSTEXCHANGE.com. Okay. So if you look at the page 3 of the brochure and down below, up above you have your identification period, your exchange period, fully deferred exchanges, and then it gets into rules to identify. So let me go into the fully deferred exchange part. When exchanging, the IRS, in order to fully defer all your taxes, they want you to buy property of equal or greater value and of equal or greater equity as to what you sell for. So if you're selling for $500,000, and let's say you get $200,000 equity out of that sale, you want to use all $200,000 equity to acquire property for at least $500,000. And you could buy multiple properties. So let's say you ended up buying 3 $150,000 properties. Oh, well, not 3 150s. Let's just go 3 $200,000 properties to exceed your $500,000. You can do that. So here's the rules to identify on. Well, the identification period is 45 days to identify. So 45 days from the day you close escrow, you must identify which property or properties you're going to purchase. You don't necessarily have to be in escrow or contract to identify. You really just submit a form to us that we provide that basically says you're going to write down your properties you're going to purchase, sign it, date it, and submit it by the 45th day, by midnight of the 45th day. And then you can go put your offers in on those properties after that, because you have 180 days to close your identified properties. But both days start ticking the day you close escrow on the property you sell. So it's not 45 plus 180. It's 45 basically plus 135. So we closed escrow today on the property that's being sold. We'd have 45 days from today to identify which property or properties are going to be purchased, and 180 days from today to close on what we identified. So it's back to the rules on what we're going to identify. The most common rule to identify is, yes, the 3 property rule, where you can for sure identify up to 3 properties. So you can identify 1, 2, or 3 properties under this rule. You could purchase all 3. Or if you only planned on purchasing 1, you could identify 3, and then you have 2 backups. So I plan on buying identified property number 1, but let's say that falls out of escrow. Now I can go put an offer on, identified property number 2 or identified property number 3. Okay, so you can identify 1, 2, or 3 properties at any value, and I say that, but you want to meet or exceed your equal or greater value in order to defer all your taxes. Okay, so that's the most common rule we use or see used in a 1031 exchange. The next rule is my example of the client selling one property. You know, they sold it for like $2.5 million, and they scooped up like 10 replacement properties in a different area. They were REOs or whatever it may be. He was buying lesser valued residential properties. He had to identify under what's called the 200% rule. So the 200% rule says you could identify any number of properties as long as the total combined value of every property you identify, whether you're going to purchase them or not, everything you put on the form, you have to put a fair market value applied towards it. The combined total of all of them cannot exceed 2 times the value of the property you sold. So going into the scenario of my example, my client sold for $2.5 million, and they could have identified a number of properties up to $5 million, not to exceed $5 million. You could go under the 200%, but you cannot go above the 200%. And that's only if you're identifying 4 or more properties. If you identify 3 properties or less, you could sell for $2.5 million, and you could identify up to $50 billion for all we care. Okay, it's only when you go to the 4 properties. The IRS doesn't want you to be able to identify the entire state of California. They give us the tax shelter, but ultimately, you know, they want to make it a little bit difficult. Why do they give us the 45-day time frame? Why can't you just close escrow on any property within 180 days? So they are making it a little bit difficult on us. And that's the hard part for you guys, is this timing. Jonathan and I were talking a little bit earlier about the timing of the exchange, which makes it difficult. Let me go real quick on the 95% rule, and then we'll talk on the timing of it, since we're going into the rules of the exchange. This one, in my experience in 1031 exchange, 16, 17 years, has been used twice. And what it is you don't fall within the 3 property rule, nor do you fall within the 200% rule, so you can go under the 95% rule. But what it says is you must acquire 95% of the aggregate value of what you identified to complete your entire exchange. So what does that mean? So let's say you sell for $1 million. I'm going to make the numbers easy. You sell for $1 million, and you want to identify 10 $1 million properties. So 10 properties you're identifying takes you out of the 3 property rule. You're identifying 10 million worth of properties takes you out of the 200% rule because you only have the 2 million. You must acquire all 10 of a successful exchange. If one drops out of escrow on that transaction, you've only acquired 90% of the aggregate value that you identified, it destroys your entire exchange. Okay, so it's a very risky identification rule. The only time I've seen it done and it be successful is in a portfolio closing. So you have a closing, it's 20 properties here and there, you know, all these properties, and it's one purchase agreement, one seller, one buyer, and it's all or nothing anyways. Okay, if you identify under the 200% rule or the 3 property rule, let's say you identified, you sold for $500,000, you identified 3 $200,000 properties under the 3 property rule. So your intent is there to buy a $600,000, so you're going greater value. But at the end of the day, something falls out of escrow, so you only acquire 2 of the identified properties. Now you've traded into $400,000 of value. You've traded down in value $100,000. You still benefit from the exchange, you just may have a tax consequence on the difference, the trade down value, which is the difference between your sales price and the total of your acquisition property prices. Okay, so they traded down $100,000, they would pay a tax on $100,000, probably be about 1/5 the tax that they would pay, maybe even less because commissions, escrow fees, title fees on their transactions may offset some of that, and it might not be a big deal at all. Okay, so depending on the amount of trade down, you could still do an exchange and benefit from it. Just know anytime you go under the value and acquire it, unless you're under the 200% rule, you just may pay a tax consequence on the difference. Okay? All right. Any questions at this point? Good? Okay. We get the transactions where our client is selling. I'm going to go into principal residence in 1031 exchange. We get the client that's selling their Beverly Hills property that they acquired in 1974 for $500,000, and now they're selling it for $8 million. There's a 121 exemption that they give us when selling primary residence. If you lived there and owned it 2 out of the last 5 years, you get up to $500,000 gain that you're exempt from paying tax on because you fall within the 121. Or if it's a single person, you know, you get up to $250,000. So in this scenario, some of our clients, since they've only lived in it, they'll move out of the property and rent it for 2 years. If you rent the property for 2 years, you qualify it for 1031 exchange. By qualifying it for 1031 exchange for 2 years, you could sell the property, do a 1031 exchange, and 121. So you can pocket $500,000 under the 121, because the 121 rule right now, it says basically you can, as long as you live in it and own it 2 out of the last 5 years, you qualify for primary residence, and you qualify for that. So you can potentially mix 1031 and 121. The other way you can mix 1031 and 121 is on some type of, we call it a mixed-use property. So let's say you live in it, it's a duplex. You live in one half and you rent out the other half. You could sell this property, let's say call it $1 million. You could take $500,000, put it in your pocket for the primary residence portion of it, And then the investment portion, you could do a 1031 exchange for that $500,000. To meet your equal or greater value, you'd only have to exchange into that $500,000 to qualify for the equal or greater, because you eliminate the principal residence portion. So just because you sold it for $1 million, so you can potentially do a 1031 exchange. Or what if you run a business out of the property? What if you have a rental house in the back that you rented out, or you rented out rooms, or there's a daycare run out of the property? So the only time just identifying what a 1031 exchange or the potential exchange is very important for you guys up front. So, because that's your opportunity for the other deals. So right when you get the listing appointment, I always, say ask, what is the property used for? Is it strictly your primary residence? Do you run a business out of it? Have you been qualifying it, or filing your taxes as an investment property at all? And see if they have to do a 1031 exchange. Okay? Don't just think because they live there, it automatically eliminates them from 1031 exchange. Now, they just live there, which is common, and it's their primary residence. Most of the time, the $250,000 or $500,000 is sufficient enough under the 121. But they always have the option. I know as agents, a lot of times they don't want to hear that, oh, let's, rent it out for the next 2 years because you want a deal right away. But if you have a client that's on the fence, debating on what to do, you give them good advice, and maybe they refer you more deals, or you get their deals down the road. So it depends on how you guys want to handle that. Okay. We do get the question all the time too, when can I move into the property? Make it a primary residence. So to qualify for 1031 exchange, you have to sell investment property and buy investment property. So years ago, 10 years ago, or 15 years ago, what people were doing is they were selling their investment property, doing a 1031 exchange, and then after a couple of years, they were converting it to their primary residence. And then after a couple of years after that, they qualified for their 121 exemption, so they could sell it at no tax consequence. So I think the IRS figured out what people were doing. There was a little loophole in the process, so they tightened up that knot a little bit, and basically said, okay, if you exchange into a property, you have to hold it for at least 2 years as an investment property prior to converting it to your primary residence. So on this regulation, they do give us 2 years. So 2 years from your acquisition date, you must hold it as an investment property. Then after 2 years, you can move into it. So let's say we acquire the property today. Hold it for the next 2 years as investment. 2 years and a day from today, we move into it. Okay, we still are good on our 1031 exchange. You cannot sell that property for 5 years from your acquisition date today to qualify at all from your 121 exemption. So if you sell it 4 years from today, they're not going to give you the 121 exemption, the 250 or the 500. Okay, sell it 5 years from today, they'll give you a portion of the 250 or 500. And let me carry that out a little bit further. So what they said is because you exchanged into it, I'm going to carry this out 10 years to make the number simple. Buy today, rent for 2 years, move into it 2 years and a day from today, and then 10 years from today we're selling it. So we got a total of 10-year ownership. 20% of it, the first use, was investment. Because you exchanged into it, they will eliminate 20% off of the 121 exemption. So now you don't get up to $500,000, you only get up to $400,000 gain. You can avoid paying taxes on due to the 121. So it's still good, but it's not, they don't give you the max. So the longer you live there, I mean, a lot of people just plan on living there forever anyway, so it's not a big deal. Okay, but you can potentially convert an investment exchange property into your primary residence after 2 years. But just know there could be consequences down the road if they ultimately plan on selling it. Okay. There's a same taxpayer requirement that you want to meet when you're doing a 1031 exchange. If I'm Ken Harris selling, I have to be Ken Harris buying the property. Okay, you get a lot of times the clients that want to sell under Ken Harris and buy under their corporation, or they're selling under their partnership, an LLC that there's 5 partners, and 5 partners want to do something different. So 3 partners want to exchange, 2 partners want to cash out and pay their taxes. Well, the LLC has the holding period on this property. So the LLC really should be the party doing the 1031 exchange. So how do you handle a transaction where an LLC partnership is selling a property and only part of them want to do it? It's tricky. They call it a drop and swap transaction. or that's part of how people handle it. The Franchise Tax Board has been auditing these transactions over the last 10 years or so and disallowing some of them. Last article I read, they're lightening their stance on these transactions. So if we all own property, all 5 of us in here own a piece of property together under ABC LLC, Jonathan and I just want to cash out and pay our taxes, and you 3 want to go ahead and do a 1031 exchange. You say, okay, well, let's deed the property from ABC LLC, and we each take a 1/5 interest in the property. And now we sell the property, and we each get our, 20% proceeds on the transaction, and we all go about our own way. Well, the problem with that, if you're going to do a 1031 exchange, is you don't have a holding period under our individual names. So if Ken Harris gets money from the sale of this property, does a 1031 exchange and buys other replacement property, and I file for the 1031 exchange, the IRS is going to say, wait a minute, ABC LLC was claiming taxes on this property. How is Ken Harris now doing the purchase of the replacement property? So you want to see if you can maybe, if you think ahead of time. The problem is I don't usually get this phone call until they're already in escrow. You want to see if you could deed it early enough to where maybe you get at least 1 tax filing under the individual names. At least to claim the intent under that individual name and have your own Social Security number. They want to match up the Social Security numbers with the same taxpayer requirement. Okay, so if you can get at least 1 tax filing. If not, some attorneys think that, as long as you deed it prior to even entering a purchase agreement, you should be okay. Scenarios like this, we always want you to double check with your CPAs and attorneys to confirm how they feel about it when they're going to file your taxes. Or I've seen one attorney try to structure a transaction. If Jonathan and I want out, the ABC LLC can eliminate us from the LLC, deed the property from the LLC to the LLC, and then our 20% interest. So now ABC LLC retains ownership and does the exchange, but you guys have to buy the same property at that point. The problem is, did the structure of the LLC change so much? Now when the K-1s are issued out of the LLC, will the IRS see that and say, wait a minute, it's not really the same LLC because the structure changed with the ownership changing? If it changes a little bit, if only one of us wanted out and then 4 of you wanted to maintain, it's fine. But once you start changing it, around 50% or greater than 50%, I think you might have a problem. So in scenarios like that, call me, have them check with their CPAs, attorneys, just to get advice on how they want to structure that transaction. But just know that we want to meet the same taxpayer requirement. The entity or individual that sells must be the entity or individual that buys. Okay? And hold the property for the next couple of years.
I have a question. So let's say that ABC bought the property. They sell the property, they buy another property under ABC. And 5 years later, they decide to dissolve the corporation. What will happen now? Yeah,
I think 5 years down the road, you're okay. As far as the exchange goes, because you claimed your intent by holding it for 5 years. I think after a couple of years, you're probably fine. I've also seen somebody. So the LLC does the exchange, right? So let's say the LLC sells the property, and then the LLC goes and buys 5 different properties in the exchange. Ultimately, saying, okay, when we're done a couple years down the road, you get this property, I get this property, you get that property, you know what I mean? But you still have to stay together for a couple years to qualify for the exchange. But a couple years down the road, of course, again, check with your CPA, see if that creates a tax consequence. But if you just deed it from the LLC to the individual at that point, I think you're okay for this 1031 exchange. Okay. All right. So we talked about identifying the 1031 exchange. You get the listing. We don't get involved in the transaction until you officially open escrow. I do recommend you call me at any time with questions. If you're getting the listing, you want the client, maybe the client's not familiar with exchange, but they may qualify for the exchange. If you need me to get on the phone with them, talk to them, give them comfort in the transaction, please call me at any time. I'll be happy to help you guys out through that process. But physically opening a file, having a transaction, we need a purchase agreement, preliminary title report, and that'll allow us to open our transaction. What we do is we create what we call an exchange agreement, the agreement between us, the qualified intermediary, and the client. We also prepare an assignment agreement. The assignment agreement assigns us into the transaction. So it really assigns us in as seller on the property that's being sold and as buyer on the property that's being purchased. Okay, we never go on the chain of title on a regular 1031 exchange though. So really, we do direct deeding. So it's deeded directly from the ultimate seller to the ultimate buyer. So you avoid paying extra document transfer tax and all that good stuff on a regular 1031 exchange. So we get it signed in, we create that two-party transaction. There's a misconception out there on exchanges that if you own property and I own property, or not, let me rewind that. There's a misconception that if you're closing simultaneously, that you do not need a qualified intermediary to do your 1031 exchange. The only time the tax code says basically you don't need a qualified intermediary is when we're swapping properties. So you own property, I own property, you're going to end up with my property, I'm going to end up with your property. You have a two-party transaction. And that's kind of what we're doing in our 1031 exchange. That's how they used to have to happen 100 years ago when they were first started doing 1031 exchanges. But now we create, with a qualified intermediary, we create that two-party transaction with the assignment agreement. The other party must acknowledge the assignment agreement. When you guys are doing your purchase agreement, you want to put in there, the tax code calls for an intent clause to be in the purchase agreement. So if you look at actually page 4, and it gives you the steps of the 1031 exchange. So if you look at the sample cooperation clause under step 1, the italicized writing there, you know, that's a real formal one. Mainly I usually see it's just the seller's intent to do a 1031 exchange at no cost to buyer. That's really all you need to do is claim the intent. And I get the question all the time, you know, do we have to put the intent for the exchange in the MLS? And I don't think there's anything in the tax code that says you do, but some agents feel like you should. And I leave that up to you guys. It doesn't disqualify your exchange if you don't. I've had exchanges where this intent clause was not in the purchase agreement. We still proceed. We're assigning ourselves into the exchange, into the transaction, and the other party acknowledges our assignment agreement anyways, which claims intent prior to the close of escrow. Okay, so once we open escrow is when we get involved. And make sure you let me know prior to the close of escrow. Sometimes people like to wait until contingencies expire, which is fine. But don't call me today and say we closed yesterday and let's set up a 1031 exchange because we need to be assigned into the transaction. Now, if you call me today and we're closing tomorrow, we still have time to get set up. We can get set up fairly quickly. I call escrow. I get the purchase agreement. I get the preliminary title report. I get any escrow instructions they may have drawn. Once we get that, usually within 24, 48 hours, documents are out for signature. If it's a rush, we could probably push documents out, depending on what time it is, on maybe the same day. The only thing that needs to happen, nothing needs to be notarized. So they need to sign the documents, complete them, send it back, and then we're ready for close of escrow. You know, it might throw a wrinkle in your escrow officer's deal if you wait till the last minute, but you know, usually they're going to work with us to get it closed because nobody wants the client to pay their taxes. Okay, you close escrow. We've done all that. We got it signed into the transaction. We're closing escrow now. So once you close escrow, us as a qualified intermediary must take the funds, the proceeds of the sale, and hold on to them to apply them towards the acquisition of the replacement property. Funds that go to the client become taxable. So they must come to us. If the client wants, we talked about earlier, equal or greater in value and equal or greater in equity. Sometimes the client wants some of the equity in their pocket for whatever reason, to pay off bills that are not related to the transaction, or they want to buy a new car, or whatever it is. We can eliminate it. Okay. We can eliminate ourselves from the value if they want to take funds that are taxable. So we call it retainable taxable proceeds. So if the client wants to put $50,000 in their pocket, they're getting $500,000 equity. $450,000 can come to us. $50,000 can go directly to them at the close of escrow of the sale. And then the $50,000 is taxable. Okay? If they want it, usually they know it, that's okay. So $50,000 is taxable. Otherwise, if they want to do a fully deferred exchange, all the equity comes to us to apply towards the purchase. Upon the receipt of funds, we'll issue a letter. One, letting them know we received the funds, the amount of the proceeds we received. We're going to give them a letter that basically identifies their deadline dates, the 45-day deadline to identify, and the 180-day deadline to close. We're going to provide them with an identification form to identify the replacement property on by the 45th day. And we're going to give them a letter that guarantees their funds with our company. The most important thing, this is my little 1-minute sales pitch for First American, one of the most important things for when picking a qualified intermediary is the financial security of your funds. So we're holding on to your funds, your client's funds. You want to make sure those funds are back. They're insured and covered. So when we get the funds, we issue a letter issued by First American Title, our parent company, saying we're going to guarantee the funds with First American Exchange. So if something were to happen to First American Exchange, or someone within the company was crooked and tried to run off with the money, First American's going to back those funds. So that's one level of security, 100%. 100%. It doesn't matter if it's $20,000 or $200 million. We're going to back those funds. We open separate accounts for every client, so we don't pool funds together for the benefit of maybe a higher interest rate. We basically open separate accounts with the client's name on it. So when we open the separate account with the client's name on it, let's say you guys woke up tomorrow and First American disappeared. Doors closed for whatever reason. Now, we've been around since 1889. I don't think we're closing anytime soon. Basically, there's an account with the client's name on it so they can retain their funds back. Okay. We also have the heirs and emissions insurance, the fidelity bond. And then because we opened a separate account, they also get up to $250,000 FDIC insurance. So there's 4 or 5 different levels of protection of their funds by coming with First American. You're backed by a major multi-billion-dollar corporation. Okay. At this time is when we're going to also collect our fee. We receive the funds. Our fee starts at $1,000. The $1,000 is collected at the close of escrow of the property being sold. This is on any property being sold under $1 million. Okay. The fee is collected at the close of escrow and kept at this time. No additional fee when you close on your first purchase. So if you sell one and buy one, you're looking at a flat $1,000 fee. We will charge $200 for each additional purchase. So if you sell one under $1 million and you buy 2, you're looking at a total of $1,200 fee. You buy 3, you're looking at a total of $1,400. So the $1,000 fee will include the sale and the first purchase. If your sale is between $1 million and $5 million, the fee jumps up to $1,500. Again, same scenario for the sale and one purchase, $200 for each additional purchase. And then if it's above $5 million, our max fee on our forward exchange is $2,000. So again, same scenario, $2,000 at the close of escrow, no additional fee at the first close of acquisition, $200 for each additional purchase.
Sorry, for the $5 million, is it total sales value or it's...
Total sales price. Total sales price, yeah.
Okay.
So those are our fees, pretty simple. I mean, most scenarios, our clients are saving, you know, $50,000, hundreds of thousands of dollars in taxes. It makes sense to pay these fees. If you guys do shop around, if you have a client who wants you to fee shop, I promise you can find a company that's a little bit cheaper than us. But to save a couple $100 to give a financial security is where you got to really judge on where you're sending the funds for the client. So we're not the cheapest. But as far as financial security goes, I think we offer the most in financial security. So be careful on who you go to if you have to refer out multiple people. Okay? And then send them to me. I mean, it's my job to sell it. You know, I mean, if you send them 3 referrals, because I know a lot of agents have to do that, you know, let me talk to them. It's my job to sell it. Okay? So we keep the fee at this point. I'm going to give you the biggest negative to 1031 exchange right now. Once we get the funds, they're tied up under what we call the G6 regulation. So it's the regulation that basically says we can only apply the funds towards the acquisition of replacement property during the term of the exchange. So your client can't come to me on day 10 and say, hey, Ken, you know what, I'm not going to identify property. Give me my money back today. I say, well, we can give you your money back, but we have to wait until the 45-day identification period expires. So funds are tied up with us for a minimum of 45 days. Okay? What happens after 45 days is we tell your client, don't identify anything, because once you don't identify anything, there's nothing to purchase, and we can send funds back to the client. So just know funds are tied up for a minimum of 45 days. Towards the acquisition or replacement property on day 1, day 2, anywhere within the 180 days. That's not a problem. But to give the client money back, we can't do that, and it's IRS regulation. Some people think it's First American policy. It's an IRS regulation we have to follow. Day 45 comes, your identification period. You guys submit an identification form. I'm going to buy this property, or this property. Day 46 comes, and you put all your offers in on the property. And you cannot get what you identified. Okay? Then we cannot send the balance of funds back until after the 180th day, because we can only apply the funds towards the acquisition of the outstanding identified replacement property. Okay? So, rewinding, Jonathan and I were talking about this earlier. When you get a listing, you know, how do you guys figure out your timing on a 1031 exchange transaction? I was telling Jonathan, you know, if you could be in escrow on a property you're purchasing, even prior to closing your sale, more power to you, because you know what you're buying. You're not identifying blindly on day 45. You don't want to identify blindly on day 45, put offers in on day 50 and not be able to get what you identified, because you cannot change your identification. So you could be in escrow in the 45-day period or prior to closing your sale. Now the tricky part is the timing. So you want to make sure you close on your purchase second and your sale first. So you got to worry about the timing. So this is your hardest part being an agent, is your 45-day time frame to identify and get something in escrow.
Sorry, could you repeat that again? So you want to close the...
You want to close the sale first, because you want the equity of the sale to roll out.
Okay.
To apply towards your purchase. And I'm going to get into reverse exchange in a minute to avoid this, but it's a much more expensive transaction, but it's a good tool to know about in some scenarios. So you want to close your sale first, money comes out of your sale, apply it towards the purchase or replacement property. Okay? So you can be in escrow prior to closing your sale, you just can't close escrow typically. Okay, you can close escrow on day 1 after you close the sale. You can close escrow on day 179, day 180. After your sale. But again, if you could play with your closing date, because remember, closing date triggers your 45 days and 180 days. So if you're looking for property, maybe, and we were talking about how, okay, the buyer needs to agree to it, but if you can negotiate in there, you know, if they want a 60-day escrow, maybe you can put an option to extend close of escrow 30 days. Buy yourself more time to find replacement property if you didn't find anything within those 60 days. Because now you have, you know, from the time you open escrow, the 90 days before you close escrow, plus the 45 days to find a replacement property. Okay. If you go into escrow prior to closing your sale, the client will have to put their own deposit down, because we won't hold the funds. But at the end of the day, we want to use all the equity of the sale. So if we have sufficient funds in the exchange, we can take those funds and reimburse their deposit back at the close of escrow. Okay, so it's possible to do a 1031 exchange and get their money back if there's sufficient funds in the exchange. Don't worry about that. Okay. So you close escrow, 45-day time frame comes, we try to open escrow, close your escrows within the 180-day time frames, and you have a successful exchange. Okay. The time frame's 180 days. Right now we don't fall on this, but if you close towards the end of the year on a sale, you get 180 days to close your replacement property, or up to your tax filing deadline date. Okay, so your tax filing deadline date is, let's say you close on December 1st. So your 180th day falls on May 1st. Okay, but your tax filing deadline date is April 15th. You must file the exchange in the year in which you sell the property. Okay, so if you sold it in 2015, you must file it for 2015 before you file your 2015 taxes by April 15th. So you have to close your replacement property prior to filing your taxes. So if your 180th day takes you beyond your tax filing deadline date, it may limit your 180th day, because you have to report it by the time you report your taxes. But you can file for a tax extension to get the full benefit of your 180 days. So it's usually not a big deal. But just be aware that that is the case. Don't let them file their taxes without claiming the 1031 exchange. Okay.
I do have a quick question for you though. If my seller is selling the property, and then if my seller is able to locate a property prior to selling it, the open escrow, so the escrow has to be a day after closing what you sell, right?
Yeah, because typically, if it's not the same escrow, Your replacement property escrow is not going to release recording until they receive the funds.
Correct.
But this escrow is not going to release the funds until they close escrow.
Right.
So usually you need a 1 or 2 business day gap.
Okay.
Unless you could go with the same escrow and same title, then you could possibly close concurrently. You know, send it both down to the county recorders and say, hey, that once this goes, then you can go on this.
Okay.
And they give themselves authorization to transfer funds within the same company.
Okay.
So that's possible if you're with the same companies for escrows and titles.
Okay.
Okay? So, but most times it's not set up like that. So yeah, you got to give yourself a couple day gap.
Okay.
You know, because you need money to move all the way around.
So in that case, we'll have to notify you way ahead of time, though.
Well, yeah, I mean, it doesn't even have to be because we're going to need to know the escrow information on the property that's being sold, and we're going to need to know the escrow information on the property that's being purchased. So prior to the close of escrow, we're going to send all our documents. Everything needs to come back signed. And once we have everything back signed from escrow, from the client, you know, we could give authorization from one escrow to transfer funds directly to the other escrow. So they don't have to come to us. So we could eliminate us as a middleman as far as the filtering of the money to buy time, you know, but you still have that 1 business day gap. Because if I close today, hopefully I get confirmation of the recording on time to release my wire. You know, once you release the wire to the other escrow company, now they need the money. Now they can release it for tomorrow. You know, if they don't get confirmation of recording prior to wire cutoff time, now they don't get it till tomorrow. Escrow doesn't release it till tomorrow. And it depends what county you're in. You know, I think Orange County has special recordings all day long, right? Recordings all day long. What county you're in.
Okay.
So, but just plan for a couple day gap,
Okay.
if possible. Okay. Let's go into reverse exchanges. So, you guys have, everything I've been talking about has been a forward exchange, sell first, buy second. Reverse exchange comes into play when you have a property you want to purchase, you know what you want to purchase, but it has to close escrow prior to being able to close your sale. So a reverse exchange comes into play. I have a couple of, I don't think I've won enough. A reverse exchange comes into play when you have to close escrow on their purchase first. So what happens is you can't exchange in the property you already own. I think I have a few more of this. Sorry. You can't exchange in the property you already own, so you can't take ownership to that property you're going to purchase. So what happens is we come in on the property you're purchasing, we create an LLC, and we buy your property or your client's property on their behalf. Couple issues on reverse exchanges. One is we don't have the equity from the sale, so where are the resources coming from to buy this property? The client either has to have all cash, or they need to come in with a portion of the cash and get a third-party loan. The problem with third-party lenders, especially on residential, is the third-party lender will not lend to our LLC because we require it to be a non-recourse loan. So a lot of times the residential properties are different. I've seen clients maybe take money out of certain accounts for the time being, maybe refinance properties that aren't involved in the transaction to try to get cash to buy the property, borrow the cash from a family member, because ultimately they get the money back from the equity of their sale. So funds to come up with is a problem. Third-party loans are a problem, and our fees are a problem too, you know, in a lot of cases, because we're going to charge at least $7,500 on a reverse exchange. So $7,500 is our reverse exchange fee. We will pass along the LLC tax of $800. Any non-residential property, Jonathan and I were talking about, we're going to require a Phase 1 environmental report, which would be required anyways if they had a third-party lender. There's an additional transaction, so there's a potential for additional document transfer tax. So let's just say after everything, they're going to pay an extra $10,000 in fees and costs. At the end of the day, if your client's saving $150,000 in taxes, it completely makes sense. If your client's only saving $15,000, $20,000 in taxes, does it make sense to spend $10,000 in fees and costs? So that's what you got to weigh out. You know, make sure it is. I have clients, some of our bigger clients, that prefer the reverse exchange because what you're doing is you're eliminating the 45-day identification period. You've already purchased your replacement property. So when you think of reverse exchange, what goes in reverse is your time frames. We close today on the acquisition property. We park it. Within 45 days of your close of escrow, you must identify what property you're going to sell. You already know what you're going to sell in the 1031 exchange, but within 180 days, you must not only close on the property you're selling, we also have to close on the transfer of the property back to them. So once we park the property in a reverse exchange, just think of it as a preservation of a replacement property for when they could do a regular 1031 exchange. So now you sell, the funds roll into the qualified intermediary as normal, and then they go and buy the replacement property, which is just the previous property we parked in the reverse exchange. So usually once you close on your sale, within a day or two after that, we're closing on the acquisition property because we already know what it is. So it happens pretty quickly. So when we borrow the funds, when we buy the property, there's a promissory note. Because if you're lending me the money, the $500,000 to buy the property, you know, we do a promissory note saying we owe you $500,000. But how you get your money back is when you close on your sale, the equity of the sale rolls down to the qualified intermediary, rolls in to purchase the property, proceeds roll into the seller's pocket, but the seller has to pay off of the note. So all the amount of money you brought in can be paid back into their pocket through the payoff of the note. Okay? So, and it's potential to have a transaction where you do a reverse exchange. Let's say we buy a property for $500,000, and then you sell a property for $1 million. So you could potentially do a reverse and forward exchange. So now you sell for $1 million, you buy one $500,000 property. Now you have 45 days to identify another piece of property and 180 days to close that. Okay, so there's always options on those transactions. Okay, so they're more tricky, they're more expensive, but it's a good tool to know about. I always say avoid it if you can, just for the fees and costs and the obstacles involved in it. But some clients love it. They don't mind paying the extra $10,000 to not worry about the 45-day identification period. And they're saving usually hundreds of thousands of taxes on the big clients. So, you know, like I said, if you're saving $15,000, you're probably not going to spend $10,000 to pay your taxes. Know that it's a tax deferral too. So if you're doing a 1031 exchange, do you guys understand basis in the property? So your original purchase price plus capital improvements minus depreciation is your basis. So whatever that number comes out to, the difference between your current sales price and that is your gain. So let's say you're selling for $1 million and you have a $500,000 gain. I mean basis. Which means you have a $500,000 gain. You do a 1031 exchange and you buy a $1 million property, your basis is still $500,000. So if you sold that property a year down the road for $1 million, you're still paying taxes on the $500,000 gain from the original property. Okay, so it's not a tax-free exchange, it's a tax deferral. But what a lot of my clients say in doing this is, I'm going to exchange forever. You know, they want the money, they want the income through retirement and everything until I die. And the whole point in that is once they pass on, you get a step up in basis. So now the value of the property, the date of the death, is the basis in the property. So the inheritance can sell it at no capital gain consequence. Okay, so the capital gain consequence is nil, but you always got to be careful of inheritance tax. You know, above $5 million, they're going to start taxing you like above 50%. But, you know, I mean, you got to have over $5 million in assets. So your standard, you know, mom and pop shop that have one rental might not be affected. But, you know, values or assets up to $5 million get there pretty quick. So a lot of people have that. But you get step up in basis. Let me talk about, try to think of everything for you guys. Improvement exchanges. Improvement exchanges, you know, I was talking about equal or greater value and equal or greater equity. An improvement exchange is, I'm selling for $1 million, I'm going to buy a property for $750,000, so I have a $250,000 trade down. But yet I know I need to put $250,000 capital improvements into the property. This works a lot like the reverse exchange. We come in, you're trading into the property the day you acquire ownership to the property, the value of that property that day. So if you just buy it for $750,000, then you have a trade down. But let's do an improvement exchange because I know I need to do these improvements. We come in like the reverse exchange. We buy that property. We lease it back to the client. The client gets on their property and does the improvements. So within 180 days of the first closing, we transfer the property back to them at the acquired value plus the improved value. But the improvements have to happen within 180 days of the first closing. So they have to have time to get enough value of improvements completed.
What's the benefit of it?
Well, the benefit is you don't have a trade down. You know what I mean? So instead of trading down and paying taxes on the trade down value, if you know you have those improvements, maybe you could get enough improvement value so you're trading into a value equal or greater as to what you sold for. Yeah. Yeah, so there is a benefit. These fees start at $10,000 because there's more liability with people doing work on it. So those start at $10,000. So again, we have to make sure, I mean, if someone comes in and says I have $50,000 of improvements, I'll probably tell them, you know, improvement exchange is not for you. Just pay your taxes on the $50,000 trade down or whatever the additional $50,000 is. But again, I mean, we've had people put millions of dollars into a property. And they have to be completed too. They can't just buy $100,000 worth of material and throw it on the yard and say that's completed. It should be improved to the property. Now, do we go out and check that? No. You know, but it should be improved, completed improvements. And we can fund those out of the exchange money. So as we're holding funds and the invoices are being submitted and approved by the client, we'll send the money off to the contractor. And then we'll have a detailed record of the acquired value from the settlement statement plus the money released. And then if we run out of money because all the equity is eaten up, then the client, if there's additional funds, the client can fund the rest of the improvements. Okay? So there's always an option, if needed, to do an improvement exchange or a reverse exchange. Okay? Any questions up to this point? Let me see. Oh, let me tell you one other thing to be careful of. Seller carryback financing. Equal or greater value and equal or greater equity. So we've had people in the past set up a 1031 exchange and seller carryback financing. Here's your problem with that. Where does the money for the loan on seller carryback financing come from? The equity of the sale. So if the equity of the sale is rolled up in the form of a note, how are you going to roll your equity into the acquisition of your replacement property? Because it's in the form of a note with your buyer on the property you sold. So be careful, call me in the scenarios where you might be thinking about seller carryback financing. The ways to avoid it is if your client has cash funds to give a loan to the buyer, use those cash funds, that way all the equity can come into the sale. So instead of using the equity of the sale for the loan, they deposit into escrow as a third-party lender would. Deposit into escrow the $50,000 for the sale of carryback financing. That way all the equity can come into us to apply towards the purchase. How we've also handled it in the past is that the note will come into our name. So we'll hold it for the term of the exchange, or at least until you close on the purchase or replacement property. It'll buy time for the client to maybe pull together the funds for it, because they want to deposit the money into the exchange. We assign them the note back, and then that way we have the money to apply towards the purchase or replacement property. So the client can buy it, they can have a third-party investor come in and buy the note while it's in the exchange, but all this has to happen prior to closing your replacement property. Or, I've seen this done twice, but there has to be a good relationship with seller and buyer. The seller of the replacement property took the note as partial payment towards the purchase price. So the note is assigned to the seller, and now payments are being made to that seller. But now the equity of the sale rolled into the purchase or replacement property in the form of the note. So I've seen that done a couple times, but that's difficult because the seller has to be willing to accept that. That's very rare. But it is an option, so you know your options on it. Okay, so be careful with structuring seller financing and 1031 exchange. Even if it's a small amount, you know, it might not be a big deal because they could just leave it out of the exchange. Remember I was saying $50,000 booth, they could take and pay taxes on it? We could do that same thing with a note. Just exclude ourselves from the $50,000. They receive the payment. They don't have to pay taxes on the note until they receive the principal balance payments. So they structure it as an interest-only note for 5 years and a balloon payment in 5 years. Then they're not really paying taxes on the capital gains until 5 years down the road when they receive that balloon payment for the principal balance. Or if you want to spread it out over the next 5 years, you're going to pay $10,000 principal down this year, $10,000 for the next 5 years to pay down $50,000. Then you kind of spread out your capital gain consequence. Because we don't know what the capital gains are going to be in 5 years anyways. But you're going to have to pay it at that rate, at what it is. Okay, so a seller carryback financing is somewhat of a tax deferral itself. But be careful in structuring it. Okay? I know I gave you guys a lot of information today, and I expect you guys to remember it. I think most importantly to come out of here and recognize when you have a potential 1031 exchange. Recognize that you need to bring it up, get me involved in it, and recognize that it's a potential, you know, good client and multiple deals for you. So always please feel free to give me a call when you have questions. I went through a lot. Do you guys have any questions at this point?
Basically, what is a good amount of capital gain
To do an exchange? You know, I don't like to say what's good or bad because every client's different. You know, I mean, if you're only deferring, you know, $10,000 gain, why spend $1,000 in taxes, or not in taxes, in a fee? You know, I mean, you gotta be able to save enough money to make sense in spending the fees. You know what I mean? But our fees are nothing. I mean, in most cases, you're going to save in excess of $2,000 just by doing the 1031 exchange. So, I mean, if it's small, have them talk to their, I mean, I do get the clients that go see their CPA and they're like, it's, you know, it's a small gain. You know, I'm just going to pay my taxes and not worry about it. And then it's not a tax deferral. So that basis doesn't play. You can defer a loss, too. I've seen clients defer a loss. So it's like you don't have a tax consequence if you just sell it because you have a loss, so no big deal. But if they're buying other property anyways, why not defer that loss? So I have a $100,000 loss on my property. I do a 1031 exchange, and I go buy a property, and let's say 10 years down the road I'm selling that property and it has a $200,000 gain. Well, I offset the loss, $100,000, now I'm only paying taxes on a $100,000 gain. So you defer a loss, too. Don't think you just have to defer a gain. Now, 99% of the customers that have a loss will not exchange, so they don't have to pay their taxes. But if they're going to buy other property anyways, why not defer the loss into it? You know, it may help them down the road.
Oh, okay.
You see what I'm saying?
Yeah.
Yeah. So instead of having a $200,000 gain, you have a $100,000 gain if you deferred a $100,000 loss into it. You know, so if you buy it for $500,000 and you sell it for $700,000, you know, the loss will help your tax consequence. Yeah. Yeah, I've only seen that done a few times, but it makes sense.
Still the same procedure.
Yeah.
Okay.
Yeah. And no, too, so many people think that equity is the gain. The equity is not the gain. You know, so many people are like, well, you know, I refinanced it, so I'm only getting $20,000 out of it when I sell it. Well, you refinanced it, so you really have a $300,000 gain. You know, so your gain is not your equity from the sale. You know, so make sure your clients understand that. Your gain is your original purchase price plus capital improvements minus depreciation. So the difference between now your sales price and that gain, I don't care what you did in between as far as refinance, take money out, your gain is different than your equity. Okay? There's a misconception out there as far as the mortgage too. So many people think I have to exchange the same debt they had on the property they sold. Well, if you sell for $1 million, you have $500,000 equity. There's another $500,000 you need to come up with if you're buying another $1 million property anyways. So you can get additional debt, you can get another mortgage, but a lot of my clients don't want more mortgage. So you can bring in cash to offset the debt. So you don't necessarily have to exchange the debt. It's a big misconception out there. So you don't have to have the same amount of loan, but you can have the same amount of loan. Okay? Good? Anything else? You guys have these brochures. I'll leave some. Feel free to hand them out to clients. Feel free to fish through my my website. It is on my card. My cards are in the brochures. It has good resources in there. You know, brochures. It has brochures in other languages. We have brochures in Spanish, Chinese, Japanese, Korean, a few different ones. There's a couple other ones too that I can't think of offhand, but we have like 5 or 6 different languages if your client is in need of it. You know, there's articles in there. Oh, let me bring up one other thing. There's a tax proposal out there that wants to, well, at first they wanted to eliminate 1031 exchange to where you can't exchange and defer your capital gain taxes. Well, they said, okay, well, let's not do that, but let's cap out what they could defer in a year. So they want to try to cap the amount that you can defer up to $1 million. So it's big for us, But depending on clientele, you know, if your mom and pop are selling their $500,000 property, it might not be a big deal. But I think it would stall the economy. You know, all my commercial brokers are in fear of it because their sellers, if they're going to have a, you know, a $5 million gain on a property, which is common, they're not going to do a 1031 exchange. They're just not going to sell because they're not going to pay their capital gain consequence if they can't do a 1031 exchange. So it's just a proposal. And honestly, in my time in exchange, there's always been a proposal out there to try to eliminate us or do something, but it's never gone through, so I don't lose sleep over it. But just to know something's out there if somebody asks you, it's just a proposal right now. It might not go through. We're in a presidential election year, so a lot of times nothing really happens with these until after we see who the new president's going to be. You know, what's going to happen if the Democrats get in or the Republicans get in, we'll see. Who knows? You know, it'll be interesting. So
they typically have a proposal on taxes, but usually never really happen.
I know. That's
just that fizzle out.
Yeah, they do fizzle out, but you know, it's like sometimes it's like how many times are we gonna fly under the radar or not? You know, they usually throw it into a big tax reform. Just 1031 exchange is part of it. You know, so we have lobbyists over in Washington that are fighting it. You know, trying to make sense out of it over there. They think they're going to save $40 billion in taxes if they eliminate it. Well, at the end of the day, you know, people aren't going to sell. It's going to halt the economy. You don't want that. Nobody wants that, other than the government. They want more taxes, and I don't think it's the right way. You know, you have people out there selling, buying, making more money, and, you know, they're spending more money on taxes anyway, so you got to be careful. They got to be careful. So, I mean, that's most of it. Like I said, just feel free to call me anytime. You know, send your clients my way anytime. I'm here to help you guys. We're part of First American Title. I think Jerry Wu helped us set this up. So, you know, Jerry, you'll probably see him more often than me. But always ask him about me or feel free to call me anytime. We're here for you guys. That is great. But thank you for having me. And hopefully we can help you guys out in the future.
Does anybody have questions on the internet? Or
not sure you got lost them. Anyone has questions? Nothing wrong with the machine. Anyway.
Because the WebEx we have sometimes we get cut off, so we don't know.
Depending on when they got cut. I mean, if they call and want to know something, I mean, I'll talk to them one-on-one too. Okay. You know, so don't worry about if they miss stuff because
it's a lot of information though.
It's a ton. It's a ton of information. I mean, I'm still learning. You know, 16, 17 years in. You know, there's always a ton of information. But that's why I always say, if you come out with anything, just come out and recognize when it's a potential exchange. And then you can get me involved. Or we can go through your client's scenario and figure out if it's good for them. You know, of course I want the deals, but I don't want them to exchange if it doesn't make sense for them either. You know? So, but just recognize it's a potential exchange, get me involved, and we'll talk through the scenarios and figure that out. You know, and always refer them to their CPAs too.
Correct.
Make sure the CPA runs their numbers and make sure it makes sense on that end. And they have to file for the exchange. You know, I don't file their taxes for them, so they have to file for it, so they have to feel comfortable doing it too. You know?
Yeah, because I could mention to you the clients on the side. There's a gain.
Yeah.
200 plus.
Exactly.
So that's what you do is just do an exchange.
Yeah. Yeah, for sure.
Right. Because right now we couldn't get a rental to move in. It's been vacant for 9 months already.
Yeah. You know, I had a scenario similar to that where a client did say, I got into a bad investment. They exchanged into a bad investment. So they sold, they bought a property. 6 months later, they called me up and said, you know what, this is a bad investment. It's not working for me. I want to exchange out of it again 6 months down the road. Their intent was to hold it as an investment property, but it didn't work out the way they thought. So they exchanged out of it and they were fine. So when I give you a 2-year time frame, like I said, it's not written in stone. It falls under your intent. Now, if you have a client that has a history of flipping properties to make money and they do something like that, you might have a problem. But if it's a one-time thing for your client, either got into a bad investment, they can claim intent, they tried to rent it out, they can prove that they tried to rent it out with whatever documentation that you keep, and it just didn't happen, and they exchange out of it, it's probably not a big deal. Okay? So don't be hard and fast on 2 years. Again, talk to me. Let's talk about the scenario, and it falls onto intent. How can you prove intent in the event of an audit to the IRS or franchise tax authority? Okay? So it's not, so if your client, they exchanged into that property?
No, they actually bought it.
Oh, they bought it outright?
Yeah.
How long ago did they buy it?
They bought it in 2010.
Okay, so they've already claimed their intent. If they want to exchange out of it, they can exchange out of it and go do something else.
Yeah. He mentioned something about consequences of taxes. I said, we have 1031 exchange.
Yeah.
But then he said for other properties.
Yeah.
So he's concerned with other property taxes, but they shouldn't be connected.
Well, they're not connected. I mean, he's gonna have to pay the new property tax with the new assessment at that new purchase price.
Yeah.
But, I mean, if he's gonna make more money because he's getting into a better investment, then so be it. But yeah, you can't change your property taxes.
Right. Well, it's not that investment.
Mm-hmm.
It's increased.
Okay.
So it's not that investment, just that it's vacant, it's not being used.
Yeah. So he's not really making money off
You're
it.
not making money,
Yeah.
but you're making equity, technically.
Yeah, you're making equity, but is he paying a mortgage on it, or is the owner free and clear?
He does a small mortgage, like $50,000.
Okay.
Yeah.
Okay, so he's paying hardly anything on the mortgage, but he is paying a property tax. He doesn't have money coming in.
There's no money
Yeah.
coming in, though.
Yes.
Like, why do you want something that has no money coming in?
I know. Why not exchange it into something
Right.
that's more desirable, that you can
Right.
get a rent, and maybe make a few $1,000s a month on rent?
Yeah, this generates some income.
Yeah. Yeah.
Yeah.
To help pay for the mortgage or the
Correct.
taxes or all that
Right.
good stuff.
Yeah.
You know?
And now the neighbor's complaining because he's not doing his landscaping.
Oh, yeah.
Yeah.
Yeah. You could exchange out of vacant land too. Think about that. So you have a client that has vacant land that's just sitting there, you could exchange out of it.
This is not very common occurrence, though.
No. Well, as long as you held it, again, you didn't buy it just recently.
And it has great loss on it, around 100,000.
Yeah. Yeah, you could exchange it
Okay, so I can change it into a property.
into a property. So if you have a client, vacant land just sitting there,
Okay.
they're paying property tax and not making any income, typically it doesn't, you exchange out of that and buy a residential property that you can get a rental income.